We begin with Peter Lynch. Time magazine has called him America's #1 money manager. During the 13 years he headed the Fidelity Magellan Fund, it was a top-ranked general equity mutual fund. His new book, Beating the Street, offers advice on picking stocks and maximizing profits, and he's here to talk to us about a lot of things. Peter, welcome to the broadcast.
I think the reason I wrote it is I try to explain to people their great advantages, their edges they have, and that they should get involved in stocks. And obviously, I didn't make a great impression because the percent of people's assets involved in stocks has gone down. In 1960, people had 40% of their financial assets, including their house, in stocks and mutual funds. I think people managed to lose money in the 80s doing it themselves because their methods were so flawed. So I really feel as though I wanted people to understand, I don't want anybody to buy a stock. I'm saying if you're going to buy a stock, you should do certain things. If you're not willing to do these things, you should leave your money in the bank. Well, I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. People worry about too much money supply, what's happening to the price of oil, who's the president, who's being nominated for the Supreme Court, it's the ozone layer. There's nothing to do. So how am I supposed to predict interest rates? How am I supposed to predict the economy? People are in industries. They're in the publishing industry. They're in the chemical industry. Why don't they just stay with that industry? You only need a few stocks a decade. People don't understand their natural advantages, and they don't use it. That's bad, number one. But worse, number two, if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going to go out and try it. But people are buying stocks anyway. They're not discouraged, they just think it's a gamble. So therefore they go forward and they bet on one stock for a week and a half and it goes up and they make $2 on it. Then they sell it and they buy something else. When 3 years is over, all they've done is generate a lot of commissions. They've probably lost money. The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, you really press them down to say, the reason I own this is the sucker's going up. I've tried to convince people there is a method. There are reasons for stocks that go up. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict the interest rates. If anyone could predict the interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, where interest rate's going to be 12%. That's useful stuff. You never know it though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. I really believe that. Economics to me is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancies. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. They're economic facts and it's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He can tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. That's known as a bear market. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. People tell you about it after the fact that they predicted it, but they predicted it 53 times. So you can take advantage of the volatility in the market if you understand what you own.